All right, so this is chapter 5. Chapter 5 is going to introduce the capital investment decision, and we'll be covering time value of money. I know it's kind of a strange topic, time value of money, but where it comes from is the concept that a dollar today is worth differently than a dollar tomorrow. So like for you, if I offered you, would you rather have a dollar today or a dollar tomorrow? Pretty much everybody would say they'd rather have a dollar today, right? Because a dollar today is worth more than a dollar in the future. And one of the big reasons for that is inflation. And so the purchasing power, right? For a dollar today, let's say a dollar today, you can purchase some article at Trader Joe's, but in a year or 2 years, that same article at Trader Joe's might cost $1.20, right? So a dollar today is worth more than a dollar in the future, because a dollar in the future may not be able to buy as much. And so we use this concept to analyze all types of financial decisions. And the reason is that financial decisions usually have different cash flows that occur at different points in time. You might invest in a business, and that business may pay no dividends for 3 years, but then it starts to pay off lots of money down the road. An alternative investment may pay off immediately, but that payoff might be slow growing. It's kind of like comparing an investment in Tesla versus an investment in Toyota. In Toyota, you'd expect to have dividends coming in right off the bat as soon as you bought the stock, and they would grow, continue to grow probably at the rate of the overall economy. If you bought Tesla stock, you might say, okay, I probably won't get much of a dividend for the next 5 or 10 years, but then I think it's going to really start paying off as they get much bigger and they get more control of the market and their manufacturing costs come down. So all kinds of financial decisions we face usually come down to using time value of money principles to analyze them. So just a couple definitions to help us talk about all the problems that we try to solve in time value of money. The first one is future value. So future value is a cash flow or money value at some point in the future. It could be in 1 year, 2 years, 3 years, 4 years, whatever. It's some type of cash flow or monetary value at some point in the future. Now, when we go to estimate or calculate future values, we'll start with a value today, and then we compound it over time into a future value. So when we take a present value amount of, let's say like we wanted to put some money in a bank account, and we want to know how much in the future that bank account will be worth. What we do is we go through the process of compounding, meaning we take the current amount of money we invest and we compound it over time to calculate the future value. And compounding is where you get interest every single year, or every single period, and it keeps growing into a future value. So that's where the compounded growth or compounded annual growth rate come from. Compounding is the process of something growing over time. The other definition is present value. Present value is a value or cash flow today. And by today, we define that as like time zero, okay? And when we calculate the present value of something, we call that the discounting process. So for example, what if I was to give you $10 million in 10 years? How much is that worth today in today's dollars? We would calculate that by discounting it back in time to today. So the discounting process will take something in the future and calculate it in today's dollars. And today's dollars is called present value. So future value and present value, that's what we're going to cover today. And then on Wednesday, we'll talk about multiple cash flows. Multiple cash flows is where we have usually multiple future values. So for example, let's say we want to invest in a project that will give off certain cash flows in year 1, 2, 3, and 4. And all those values are different. Your year 1 cash flow is different than the year 2 cash flow is different than the year 3 cash flow. We call those multiple cash flows, and we can take those multiple cash flows and calculate one present value that represents the same total value of those multiple cash flows in the future. So that's another type of problem. We'll cover that on Wednesday. Also on Wednesday, we'll talk about something called a perpetuity. And a perpetuity is basically a steady stream of cash flows, the same amount every period, and it lasts forever. That's a perpetuity. And there are some cases in finance where a perpetuity, using that value for calculating a perpetuity comes in handy, especially for organizations or funds that have an indefinite lifespan. Like when, like if someone were to give money away to a charity or set up a trust fund and they want that money to last forever, they'll start using some of the math that we're going to cover in perpetuities to figure out how much money they have to put into that fund so it'll last forever. And then we have annuities, and annuities, we'll cover that Wednesday again. Annuities are basically a set of cash flows, the same amount every period for a given time. Sometimes people, when they do their retirement plans, they will buy annuities, and sometimes those annuities you might pay a certain amount for it, and then when you retire, you get a certain number of payments after that. And it's the same amount of money every period, but for a given time period. It could be 5 years, 10 years, 15 years, whatever. And the key difference is an annuity only lasts for a certain amount of time, but a perpetuity lasts forever. And those are, again, different types of cash flows. And then lastly, on Wednesday, we'll talk about interest rates. Since you'll see interest rates go into every single one of these calculations that we do. First off is future value. So in this case, we want to calculate the future value of something that we have today. And what we have today is PV, or present value. Future value is what that will be worth at some point in the future. R in this equation is the interest rate. You can think of it as the compounding rate. It's the rate of growth. And T is the number of time periods that you're going to allow that present value to compound and grow into the future. So for an example, like if you were to put money into a CD, a certificate of deposit at a bank, the amount of money you would put into that CD would be your PV, or your present value. The R would be the interest rate, or that the bank promises you that you will receive every year. T is the number of years that you will leave it in the CD to grow. So how much will your CD be worth at the very end? How much will your account be worth? That will be future value. And so then you can estimate how much money you'll have at some point in the future, given a certain interest rate and investment. Let's take a look at some examples on how to use this equation. What will $100 be worth in 1 year, assuming you can invest that at 2% interest per year? So you could you might be able to do that pretty quickly in your head, but let's use the formula so we can see how that's used. So this is the formula that we just looked at. Future value equals PV, present value, times the quantity 1 plus R, all to the power of T. So T is the exponent. That's what that little up triangle caret means. So how do we solve that? Well, let's first identify all the pieces of information we need. PV in this case will be 100. That's how much we're going to invest today. R is the interest we'll get. That's 2%. And T is how long we're going to invest it, and that's 1 period or 1 year. So if we plug that into our equation, we get 102. Incidentally, you know, if you do this on your calculator, right? You've got that little key. You have to use that key with a y to the power of x, right? So if you're using your calculator to solve this problem, you'll have to use that y to the x key on your calculator. And I know it depends on what type of calculator you have, but usually they all have that y to the x key. Here's another example. What will $100 be worth in 5 years, assuming you can invest at 2% interest per year? And this is the process of compounding, right? We're compounding an initial investment. We're allowing it to grow on top of itself for 5 years. So again, we use that future value equation, and we identify the data information we need. So we've got same $100 investment. The interest rate's 2%, but this time it's 5 years. Plug that into our equation, and we get $110.41. So that's $100 grows compounded at 2% per year into $110.41. Now, there are a couple ways to solve these problems. One is to use, a piece of paper in your calculator or whatever, and that's where you use that y to the x key on your calculator. Another way to solve these problems is in Excel. And you can put the math like we just did in Excel, or Excel has a special formula just for time value of money problems. And it has a formula for future value you can use. It has a formula for present value. And so I wanted to show you now the Excel formula for future value. And for some of the problems, it'll make it easier, especially when you see some of the later examples we do, where it's definitely a lot easier to use the formula for things that we want to calculate later. So let's take a look. So here's the formula, FV. So this is what you'd exactly type into Excel in the cell, equals FV, and then the parenthesis, you'd have to put in the rate, then you have to put in the number of periods. N per is like T from the previous slide, but Excel calls it NPER instead of T, like we do in the textbook. PMT is a payment. Now, PMT stands for a recurring payment, the same every period, kind of like we see in annuity or perpetuity. But today we're not going to use that at all. So you'll see in the examples we do today, PMT will always be 0. Later on Wednesday we'll use that. And then PV, which is present value. The last thing, type, we're not going to really use that, and so you leave it blank. And it basically tells Excel when the cash flow happens within a period. And for us, we always assume the cash flow happens at the end, and that's the default value, so it's okay to leave it blank. So that's the formula. And now when we go back and look at those same problems we just did, we just have to figure out what numbers to put into those, in between those parentheses on the Excel formula. So let's take a look at that. So what will $100 be worth in 1 year, assuming you can invest at 2% interest per year? Right, so we have to identify the information we need. First, the rate is 0.02. The number of periods, or T, is 1 year. There is no recurring payment, PMT. The present value is 100. and the type, again, we can leave blank. So what this means is this is the formula that you would type into Excel. And that should give us the exact same answer that we got a couple slides ago on the using math. That's what Excel will give us back. And if you remember from the last slide, we had 102 was the answer. But now when we do it in Excel, it gives us a red 102 in parentheses, right? And that basically means a negative number. And so why does Excel give us a negative number? So this is kind of a peculiarity of how Excel works. And you will see this if you use financial calculators as well, because the way they're programmed is that if you give it a present value and then calculate a future value, it always gives you the opposite sign, so that what the algorithm in Excel and financial calculators do is they're trying to tell you what direction the cash flows are going. So before, let me give you an example. Like if initially you give someone $100, you loan it to them, and later on they give it back to you with interest, they give you back $102. Those cash flows are going in different directions, right? You give 100, you get back 102. And so whenever you use Excel, it keeps track of the direction of the cash flow. And for a lot of the problems that we do, at least today and even Wednesday, we're not too worried about the direction of the cash flow. We can just use the simple present value calculation without worrying about the signs. But Excel keeps track of that. And so I think it's a matter of just doing enough problems, and then you get comfortable with it, and it's not a big deal. But that's kind of how Excel works, okay? And for example here, if we put in a negative $100 in 1 year, what will it be worth in 1 year? Then it would have given us a positive 102 answer. So let's just do more examples, and I think you'll get a feel for, you know, how it changes the sign like that. It's not a huge deal. Because you can kind of just ignore it. So the homework answer for this problem would be 102, okay? The next question, what's $100 worth in 5 years, assuming you can invest at 2% interest per year? Again, we just pull the information that we need to plug into the Excel formula. The interest rate is 0.02. The number of periods, NPER, is 5. There are no recurring payments, so PMT is 0. The present value is $100, and so that we can just plug in then, and that's what our formula looks exactly like in Excel. So you would actually type that in, equals FV, parenthesis, 0.02, comma 5, comma 0, comma 100, end parenthesis. And then if you hit return to send that to enter it in Excel, this would be the answer you would get, negative 110.41. And so in that case, your homework answer would be 110.41. Okay, so what's $100 worth in 5 years? It's worth $110.41 if you invest it at 2% interest per year. Okay, so you know, seeing how the question is answered, it makes sense. You put in $100 and you get back 110 in 5 years. Excel is just keeping track of the direction of the cash flow, and that's why the answer is negative in Excel. Okay, let's take a look at present value. So we'll do the same thing again here. We'll take a look at the math and how to solve the present value problems just with math and a calculator, and then we'll also look at how to do it in Excel. So FV stands for future value in this problem. It's some dollar we can get in the future. PV is the present value of that future dollar. R is the interest rate, And in this case, sometimes when we're discounting, taking the present value, we call it the discount rate. You'll see later on when we do examples that when a company has to determine what that R is, they'll often use their cost of capital, how much it costs them to get money or cash. And then T is the number of time periods. So here's an example. If you receive $102 in 1 year, what is it worth to you today in today's dollars, or what is the present value? Assume you can invest now at 2% interest per year. That's basically your cost of capital, or the best available opportunity cost of capital you can get. So like, it's kind of like when we talked about opportunity cost of capital. When an investor surveys all the available investments out in the world, what is the best return they can get? So for you as an investor, what is the best interest rate you can get when you look around all the different opportunities? So that's kind of the opportunity cost of capital. What's your best opportunity? Here's the equation that we just looked at. It's basically future value divided by 1 plus the interest rate to the power of T. Here's the information we need. We need the future value, the number of periods T, and the interest rate R. We plug that in and we get $100. Here's the next question. If you will receive $110.41 in 5 years, what is it worth to you today, assuming 2% interest per year? Whenever we do time value of money, we always assume that like if we're looking at someone putting their money into a CD account and trying to figure out how much it'll be in the future, we always assume that interest will be reinvested into the account. That's called compounding. And so that means interest is reinvested. When we don't do that, it's called simple interest. So we have compounding and we have simple interest. And simple interest is like when you take your interest every year out of your account, and that means then that your account never grows because you're pulling out the interest every year. That's simple interest, and we don't really assume that anytime in time value of money, right? Because if with simple interest you pull your interest out, there's no growth. And so whenever we're doing time value of money, we kind of always assume interest is reinvested, and that's how you get growth over time. So that's just an aside. So in this example, if you receive $110.41 in 5 years, what is it worth to you today? We need to know the future value, which is $110.41. We need to know the number of periods, which is 5, and we need to know the interest rate, which is 2. So that's our math formula to solve the problem, and we get 100. Okay, pretty simple, right? Let's look at the Excel formula. The Excel formula looks like this. You type in equals PV and then parentheses, and then you have to put in a number for the interest rate, comma, then the number for the number of periods, comma, then any payments, recurring payments. For our problems today, it's all going to be 0, and then comma and the future value. That's a future value in this case is one lump sum payment at the very end, and then comma for type. And for us, we just leave type blank. So there's the interest rate, the number of periods, payment, future value. Now, I'm going to show you Excel a little at the end of this, and you'll see Excel has some help functions where you can click on the formula and it'll walk you through how to put it in. And these are the abbreviations they use. So I copied this from Excel: rate, comma, NPER, comma, PMT, comma, FV. That's all Excel kind of talk. if you will. So let's do an example here. What is the, let's see, if you will receive $102 in 1 year, what is it worth to you today? Assume you can invest now 2% interest per year. So the rate is 2%, number of periods is 1 year, the payment's 0, there are no recurring payments. Future value is 102. So now we just want to calculate the present value. That's how we put it into Excel, right? And then we get back negative 100. Same thing we had before. When Excel gives you a value using these formulas, it'll give you the opposite sign that you put in, basically, because it's balancing an equation inside the software, and so what comes in has to come out the other way, and so you put in a positive number, you get back a negative number. So the homework answer here would be 100. How about if you'll receive $110.41 in 5 years, what is it worth to you today, given a 2% interest rate per year? So again, identify all the data you need. You need the interest rate, the number of periods. Are there any payments that happen every single period? No, not in this case. But there is an FV, a future value, one single payment at the end, and that's 110.41. So let's go ahead and plug that in, and we get the equals PV 0.02 for the interest rate, comma 5 for the number of periods, comma 0 for the payments, comma 110.41 for that future value single cash payment. And surprise, surprise, a negative 100. So your homework answer is 100 there. Let's take a look at another practice problem then. Let's say you buy a new recliner and can pay either $600 now or $800 in 1 year. So you're going into the retailer, and the retailer, when you're buying this furniture, they give you an option: pay me now $600 or pay me in 1 year $800. And so you're forced to decide upon these two options and which one is the better one for you. And so here's the standard way to solve these problems where you have multiple options. Just remember, calculate the present value of each option. That's how we solve all these problems. Just practically every single problem we do, when you see different options, just remember, calculate the present value of each and then compare those present values. Because here's the difficulty, right? Because whenever you see these different options, they're different amounts of money at different periods of time. And like we say, it's like comparing apples and oranges. They're not, you can't directly compare $600 today versus $800 tomorrow. You know, there's not enough information there for you to make a decision. And so what we have to do is we have to put those two numbers at the same period in time. And that same period of time is always present value, times 0. Okay? Now, but the other thing we need is the interest rate. And on these problems, I'm going to give you the interest rate, and it's 25%. But in the real world, what you would have to do is you would have to find your opportunity cost of capital. How much would it cost for you to take out a loan for 1 year? So you could go up and look up the cost of a personal loan from the bank, or you could look up your cost of a loan by buying it with a credit card and not paying it off for a year. So those are two examples of how to get your own personal interest rate or your own personal cost of capital based on what opportunities you have. But usually I'm going to give that interest rate to you here. It's 25%. So again, solve the present value of both the options. And since this is a cost comparison, we're going to choose the lower present value as our answer. Now, option 1, it says pay now, right? So it's already in present value terms. In terms of the timeline, it's at time 0. And so present value is 600. It's the same as the cash flow because it's already a present value. Let's take a look at option 2 now. Option 2 says pay $800 in 1 year. So the strategy here is let's take present value of $800 in 1 year. So we go into Excel. I'm going to skip over that one bullet point. We go into Excel and we calculate the present value, and it gives us a value of negative 640. So the cost is $640 in present value terms. Now we compare that 640 to option 1, which had a present value of 600, and choose the lower one. So in this case, option 1 is lower, right? So that would be our answer here. So we looked at some examples where we calculated the future value of some money that we invested today. We looked at some examples of calculating the present value of cash flows that'll happen in the future. But there are some other types of problems we can solve for in time value of money. Because we have present value, we solve for that. We have future value, we solve for that. But we can also calculate the necessary interest rate to get from a present value to a future value. What does the interest rate have to be to get from a present value to a future value? And if you remember, we did something like that when we were calculating CAGR, compound annual growth rate. So compound annual growth rate, CAGR, is the term used when we're doing financial analysis in a company and we're talking about how fast the sales are growing or how fast cash flows are growing. But when we're looking at analyzing capital investments, we use the term internal rate of return. Internal rate of return is kind of like the growth rate needed to grow a certain amount of cash from one number to another number, or the rate of return you get on an initial investment as it grows to a future value. So let's look at an example. What is the internal rate of return if you invest $100 and get back $1,000 in 10 years? Now, having gone over CAGR, compound annual growth rate, you can just use that formula and you can calculate it. But let's use the time value of money formulas to see how that works. We can do that in Excel. And if you look at the notes on this slide down below, not on the slide itself, but in the notes section, I show you the mathematical derivation to get from the time value of money calculation to that CAGR formula we looked at a week or two ago. It's a little of a pain in the neck, and so for our purposes here, I think it's best if we just go through Excel, if that's okay with you. But if you want to see the math derivation, just go below and you can see that in the notes section. So here's the formula that Excel gives us. It's called the rate formula. So, and then you have to put in a couple pieces of information and it'll calculate the internal rate of return for you to get from one sum of money to allow it to grow over time into a future value. So you need the number of periods, N per, you need the payment, PMT, the present value that you're investing, the future value that you're going to get, and then type, which we usually just leave blank. So here's the information we have in this problem. The number of periods is 10, because we're going to invest it for 10 years, we said. The payment is a recurring cash flow at every single period. We don't have that. That's 0. The initial investment is $100. And notice how it's a negative 100. This is the way Excel talks. It assumes that if you give me some money today, I'll give you back a certain amount in the future. And so these cash flows have to balance each other out. And the negative sign tells you what direction the cash flow is going. So on this one, think about it like this. If the cash flow sign is negative, from your point of view, you're giving that money away. All right, so at time zero, present value, you're going to give away $100. You're going to invest it. You're going to give it to somebody. And then in 10 years, you're going to get $1,000 back to you. That's a positive cash flow. So that's how Excel understands the direction of these cash flows, and they're looking to, to get these balanced from inflows and outflows. Okay, so you have to use that negative sign here when you're putting in a present and a future value, both in the same problem for Excel. So I put in a negative 100 and then a positive 1,000 for FV, and you put that into the formula. It'll look like this: equals rate, parenthesis 10, comma 0, comma negative 100, comma 1,000. And that's the number of payments, the number of periods, if there are any payments, which aren't in this case, the present value cash flow, and then the future value cash flow. So you go ahead and calculate that, and you get 25.89%. So we can solve for present value, we can solve for future value. We just solved for the interest rate, and now we can also solve for the number of time periods. So look at this example. If you have $100,000 now and want to put it into a savings account to grow to 2,000, how many years do you need to invest it at 2% per year to grow? So it's basically asking us, how many years will it take to double our money at 2% per year? That's basically what it's asking us. If you invested $1,000 at 2% per year, how long will it take to get to $2,000? So if you look at that PV formula, the formula for calculating present value, we could do algebra on that to solve for T in the equation. But that would be a real pain in the neck. Let me just show you here. So that equation, how would you like to do some algebra to solve for T? That's what I thought. So for our point of view, I think it's going to be more efficient if we use Excel, or we just, if you're really interested, you can look at the notes, and on this slide, you can see the math derivation to get the formula. I don't think it's that important, so I'm gonna cover the Excel formula. Okay. Here's the Excel formula, and this is called NPER, number of period formula, and it calculates the number of periods needed at a certain interest rate to grow your money from a present value to a future value. Here's the data we put in. The interest rate is 2%. There are no PMTs or payments. The PV is we're going to put in $1,000, so it's a negative cash flow. It's money we're putting into an account. So for us, we're giving up that money, putting into account, and then the future value is a positive 2,000. So that's money coming back to us. And again, that's what Excel needs to balance these cash flows when it does the math inside the program. So this is what the formula will look like if you type it into Excel. Equals NPER, parenthesis 0.02, interest rate, comma 0, no periodic payments, comma minus 1,000. That's the cash flow at PV times 0. That's how much you're putting into the account, and then comma 4,000. That should say 2,000. Sorry about that. Then you get 2,000 back, and that's a positive cash flow. And 35 years.
That's a long time. Is that like realistic for some people? They wait 35 years to get their money back, or like double their money?
You know, I think I put in 4,000 by mistake here. I think that was the problem.
Oh, okay.
Yeah.
I was like, I feel like there's quicker ways to invest to get money back quicker.
This is why a financial advisor will tell you not to put all your money in a savings account in the bank, or put all your money in a CD. because it'll grow very slowly. And once you factor inflation into account, you're kind of almost no better off than you were when you started. Yeah, 2% is a pretty low interest rate, although right now it looks pretty good, probably, right? What are savings accounts paying right now?
I'm pretty sure mine's like 1% or
yeah,
0.01. I don't get much.
yeah. CDs, I can't imagine are more than 1 or 2% right now.
So what would be better than going into like the stock market or like investing in like an
That's why the stocks are so high right now. It's all because the opportunity cost of capital. Look at let's just say you had $1 billion to invest. What are your opportunities? You could put it in a 30-year treasury for 2 or 3%, or you could buy a stock that's paying like a 3, 4, 5% dividend every year, plus the opportunity of having it grow in value. So that's why the stock market's so high, because interest rates got cut so much. And so it forced investors to buy stock, because interest rates on bonds and savings accounts was so low, it forced investors to buy stocks. That's kind of what the Fed was doing. And that's why the stock market got so high.
Good to know.
I have a question.
Yeah.
So on this question, I plugged it into Excel, and the answer came out to like 35.002. So on a homework question, would that be 36 years or 35 years? So you can't have, like, it won't be complete until after the 35th year is over.
Yeah, that's a good question. I will try not to make it so that you're faced with that decision. I will make it clear which one is if you have the right answer. Yeah, because it's not really 35. You can't round down time, right? Like if someone tells you you're going to live to 35 and a half and they come at age 35 and say it's time, like, no way, I have another half year. So I would say normally you would round at some point, right? And the only danger is if I give you an answer D or E that says none of the above. So look at the significant digits or the number of decimals in the answers, and that's what you should round to.
Okay, got it.
But if there's something confusing, I'm not trying to trick anybody, so I would fix it and probably give you the point in the homework or the quiz if there's a situation like that. I would try to make it clear that, as long as you calculate it right, it shouldn't be a question of guessing how to round, okay? That wouldn't be my intent, but at some point you're probably going to have to round it. So yeah, you can't really round down with time. So I will just try to make enough decimals in there so it's clear, the answer, okay?
Okay, got it. Thanks.
That's a good question, though. So so I'd say equals NPER. And notice this, as soon as you plug in the formula, it kind of helps you out here. And if you hit this button right up here, the FX button, function button, it'll, I don't know, you probably can't see that. It comes up with another window that where you can enter all the data in, but you guys can't see that because it's a separate window.
I just saw that like little window which showed like rate, payment, and like you can type it in.
Oh, you can see that?
It did pop up for a second, yeah. Yeah, there it is.
Okay. So if you're ever confused, you can always go here and when you put your cursor in the little boxes, it says below what it is. It kind of defines it for you. So if you're ever confused, because I'll be honest with you, I don't necessarily have all these memorized. So sometimes I have to remember which order to put the numbers in, so I have to look it up myself. I did it in Google Sheets a while back, and there was something a little different than Google Sheets, but you can do these numbers in Google Sheets as well, but just make sure you go through and look at the instructions and all the formulas so that you're doing it right. In fact, if we have some time at the end of the class, we can look at Google Sheets too if anybody wants to. So equals NPER, right? And then we put the interest rate in, 0.02, and then we put in the payment, which is 0. And then the present value is minus 1,000, and the future value is 2,000. Wow, 35 years. So think about that. If you put your money in CDs, it's going to take you 35 years to double your money. That's why the stock market's so high right now. I want to show you something else here too. Look what happens if we forget the negative sign, right? So I told you not to do this, right? Don't put in all positive values for both future and present value. And so if you do it and you see this pound sign, num, exclamation point, it's basically, it means that you need to put a negative sign on one of your cash flows, okay? I don't see num. It doesn't tell you exactly what the problem is, so you just have to remember, put a negative sign on the PV. That's what I would suggest doing. Okay. And so that was, what do we say, 35.29 years?
35.002.
Okay, here's some more problems. Which is worth more, $1,500 in 1 year or $2,379 in 5 years? Assume the interest rate R is 12%. So how do you solve a problem like this?
Do you use the future value equation? Because are those the present values of the amounts, or are those the future values?
So these are future cash flows, so they're future values.
Oh, okay. So they're not the present values. That's where I got
Right, right. So, yeah, if it was present value, I would say something like $1,500 now or $1,500 today. But if it's in 5 years, that means it's in time 5, year $5.
Got it.
So when we're comparing these options and we have different cash flows at different time, the standard way to solve this is calculate the present value of both options. So let's go ahead and do that. So option 1, what's the present value of $1,500? And I'm using the math here. So it's $1,500 discounted back 1 year at 12%. So it's 1,500 divided by 1 plus R, 1.12, to the power of the number of years, which is just 1, so it doesn't show it here, 1250. If we do it in Excel, the Excel formula is going to look like that, and you're going to get a negative 1250. On option 2, the present value using the math is going to look like that. It's going to give you 1349.9. And the option 2 in Excel is going to give you negative 1349.9. So you kind of have to look at the question in terms of figuring out what option you want. And in this case, it's giving you two values. You can have either one. And so you're getting, it's almost like you're getting free money, right? So you kind of have to ignore the negative signs in Excel in this case, and just look at it as a positive cash flow. So in this case, you'd want option 2 because it's almost $1,350. It's more. And ignore the negative sign because that's just showing you the direction of cash flow being opposite than the beginning of the problem. So, okay. So option 2 is worth more. So here's another one. You can buy a new motorcycle by either paying $10,000 cash now or $12,500 in 2 years. Which one would you rather do? So what you have to do is you have to find out what it would cost you to borrow the money. And that'll give you your interest rate. And so let's say that interest rate is 12% that you find out. So now we take the present value of both options, and then we compare those present values, and we're going to pick the lower one because this is a cost to us. So we want to pay the least amount of cost possible. Option 1, it's already in present value terms, $10,000 cash now. So we don't have to do anything with that. Option 2, the future value is $12,500. Number of time periods is 2, and the interest rate R is 12%. So let's calculate that. And the present value is 9965. So which one's cheaper? Option 2 is a little bit cheaper, so we go with that one. Now in the real world, you know, maybe you don't want to deal with having to pay someone in 2 years, and you know, $35 in present value is not a huge difference. So there might be other factors to take into account when you're comparing financing options, like making it easy on yourself, making things simpler. Maybe you don't want to have a loan. So this is just looking at it from a purely numbers perspective, and it's not taking those kinds of factors into account. So so just keep that in mind. That is it for today, okay? And then the other slides we will cover on Wednesday.